Hello, chart watchers, and welcome to this Tuesday, July 10th, Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Dow Jones Industrial Average powering forward once again today. See it up 150 points, nearing 25,000, just about 70 points to go to get to that level. The S&P 500 nearing 2,800, big overhead resistance. This is clearing the high that we saw second week of June, but earlier we have struggled around the 2,800 level. Currently, the S&P at 2,794. The NASDAQ getting close to an all-time high that we saw recently. Needs to get through that 7,800 level. We're sitting at 77.71 right now, up 15 points today. The Russell 2000 backing off from an all-time high that it hit earlier in today's session. Currently, it's down 4 points and underperforming on a relative basis at 1,700. 10-year Treasury yield continues to move higher. Not really a whole lot of economic news. So it looks like the bond market just kind of waiting for something, a catalyst for that breakout to the upside on the yield. Volatility continues to power lower. It's been down mostly over the last couple of weeks, but it did reach a key area around 12, just below 12, where we do, or at least recently, we've seen bounces on the VIX. The XLE energy leading today, got up to 78 earlier. It's traded quite a bit off of that earlier high, but it is negotiating the 77 level, which is where we have seen resistance over the past couple of months. Financials and industrials, after huge days yesterday to clear, 20-day moving averages, you can see both just struggling near the flat line today. I find it good news, though, that they are at least holding their gains and holding above the 20-day moving average. One of the top performers in the S&P 500, the same as yesterday. Actually, I think yesterday at this time, Noble Energy was leading the S&P 500. Today, it is also having another pretty solid day. I think it was the second best energy stock in the S&P 500. We were looking to see if we could clear this 36 level yesterday on Noble. It did. It's continued moving higher, and it's trying to make a breakout above 37 today. Let's see if we can get a strong close on NBL. PepsiCo reported earnings that exceeded Wall Street expectations. Stock currently up about 3.6, $3.60. And Micron leading a strong semiconductor group. Micron and NVIDIA both trying to get back up, negotiate some key moving averages, get through some gap resistance. So the semiconductors will be worth watching later in the session. Okay, Erin, it's Tuesday. What is it, July 10th? Wow. Midsummer. Has it cooled off there?
Actually it has, because we're now back down under 100. So we're looking at high 90s for the rest of the week, which is honestly a good thing, given, we've been well over 109, 110 last Friday, 115. It was pretty crazy. But yes, we're cooling off, high 90s. I'm pretty happy about it. And we really don't get the humidity like you do. So high 90s isn't horrible.
Yeah, I'm a fan of the 70s, both in terms of weather and my golf score.
Yeah, I kind of liked the music back then too. So
hey, there we go. 70s. There's a trifecta.
There you go.
Very nice trifecta. Well, I'll let you get going because we got a ton to go over today.
Oh, definitely, because I know you have a workshop coming up here. So the rest of the week, what we have, Tushar Shande is going to be with us tomorrow as our special guest. Grayson Rose is going to join us Thursday as another special guest. And Friday, I will be doing the regular sentiment update. So it's been very interesting lately. You'll want to tune in on Friday to see what the current numbers are. Today, we do have, Tom, you're doing a mid-year review. I think that was a great idea for your workshop. So I'm looking forward to hearing that. 10 and 10 to 1, our first symbol is going to be SAIC. I know it's called Science Applications, but I always knew it as SAIC in the Air Force too when we used to work for them, or they used to work for us, I should say. Bottom feeders is going to finish us off for today's agenda, and we'll explain that particular segment a little bit more later in the program. But let's go ahead and get started, Tom. Let's look at the technical news and headlines today.
Okay, yeah, there really wasn't a whole lot going on in terms of economic news. So the 10-year Treasury yield, you can see sitting currently at 2.86%. So it's really flat, just up slightly from yesterday. And again, we continue to kind of bounce up against that overhead resistance at the 20-day EMA, unable to pierce through. I'm sure the financials and the industrials would love to see a little bit more of a move in the 10-year Treasury yield to the upside, especially the financials, the banks, the life insurance companies. Those areas of financials tend to do extremely well when the 10-year Treasury yield is rising. And of course, over the past month or a couple of months, we've been seeing it more consolidating off of those gains where we had topped out on the 10-year Treasury yield here at 3.11% just about 2 months ago. So we'll see as we get more and more economic news down the road, and as we get more earnings reports, they're getting ready to kick into gear. We got a big day coming up on Friday with a number of banks, JP Morgan, Citigroup, PNC Financial, and Wells Fargo, all reporting on Friday morning before the bell. And that's going to set the stage for the banking area. And I'm just going to pull these couple of charts up. You can see the banks, and you might look at this and say, well, you know, this has been a really weak area, and it has. In 2018, this has been a lagging group. But I do think it's a good idea always to go back and take a look at the longer term picture. And when we pull this up, I think you'll see a little bit different picture. Yes, we've been consolidating. Yes, we've been downtrending on the banks for the past few months. But we broke out at about the 450 level, maybe 455, and that 450, 455 area has been holding to the downside. Now, we keep moving up on a weekly basis, trying to get back through that 20-week moving average. We had a couple of weeks where we were successful. You can see already this week, we've gotten as high as 471 and change. The 50-week is at 50-week moving average is 462. So we have tried to get back through, but currently we are at 467. And actually, the 20 week, excuse me, is 469. So we're trying to get through that. We had it earlier today. Let's see where we finish the week and whether or not we can put a couple of weeks back to back together. But I think the earnings reports coming out on Friday are going to have a lot to say about what happens to the banks going forward. Keep in mind, and I'm kind of relying on this a little bit, Jamie Dimon had previously discussed his expectations for the 10-year Treasury yield to rise to 4%. And so a lot of their projections and expectations are based on an interest rate environment that is rising. What we've seen over the past couple of months is an interest rate environment that has been declining. So has Jamie Dimon, changed his thoughts there, and what might that have as far, what kind of impact might that have for JP Morgan looking out over the balance of 2018? That's going to be an interesting earnings report, one of the more interesting ones that I'm looking forward to this earnings season. So we'll take a look at that. I can bring up JP Morgan for you. It's one of the probably the more looking for the word, can't come up with it, but it's visible. There we go. One of the more visible bank names out there. You can see we did gap up earlier today. We've reversed back down. We're only up 3 cents right now, but we did test the 50-day moving average. But during a period of consolidation, you can see how many times we've moved up, above, and below these moving averages. That's really not what I'm overly concerned about. Again, I think if we stretch it out, look at the weekly chart, long-term weekly chart, what you're going to see is at the most recent high in early March for JP Morgan, higher prices, lower PPO, negative divergence. Right at the top, we had a reversing bearish engulfing candle. I think that was that combination set the stage for some consolidation for JP Morgan, which we've seen the past 3 or 4 months. But we did come down effectively and hit this area of support between 100 and 105. We had a number of lows where we were holding 105. We had the breakout at 100. So that's a key area. Notice the 50-week moving average right now at 103. A lot of support coming in this area, and we are seeing JP Morgan beginning to bounce as we head into its earnings report on Friday. Let's see, what else do we have? I wanted to mention the sodas. This is the soda index, DJUSSD, or soft drink index. And this was a pretty sizable breakout here today with Pepsi's report. We had struggled around 620 on a daily chart. You can go back and look at the April highs. We had a double top at 620 just 2 days ago, well, back on Friday. We had a top again at 620. We backed off yesterday. And then with Pepsi's report this morning, Pepsi actually announced that, their earnings came in much better than expected, 161 versus 151. Their revenues fell a little bit short, 16.09 billion. Market looking for 16.12 billion. but the market did react positively to Pepsi's report, seeing a nice breakout here. And if we pull up Pepsi's chart, you will see that Pepsi having a very nice day today, stock up 3.7%, also clearing that double top back in April. So the soft drink index and Pepsi going along for the ride here to the upside. Looking pretty good. I mean, I think as long as Pepsi holds its rising 20-day moving average, I think this is a pretty nice looking chart, especially for being in the consumer staples. Pepsi seems to have bottomed right about when the overall staples bottomed. One last chart I wanted to show was the semiconductors. I mentioned Micron having a nice day today, and NVIDIA having a nice day. This group came up, you would think, with a PPO that was accelerating to the downside, that we would come up, maybe hesitate at that 20-day moving average, but we're going right through it, and we are in the midst of a pretty solid gap resistant zone. A breakout on this index above about 35.60 would be very bullish, in my opinion, probably leading to another push back up toward the highs at 37.50 in early June. Okay, I'm going to turn it over to Erin. She's got a number of upgrades and downgrades for you. Take it away, Erin.
All right, let's indeed take a look here. All right, I'm going to start off with the upgrades. I'm going to just show you the ones we have. We have a lot to look at today, so I'll try and scoot through them, but we had 3 upgrades. I'm going to start with KB Home, which was upgraded today. These upgrades I thought looked really good, and some of the ones that came in on downgrades I actually thought looked pretty good. So anyway, let's go ahead and start. KB Home, I really like this. This is actually a declining trend channel, and it is now busted up above that. Also, that coincided with overhead resistance at these lows back here from March and April. So not only did it leap over the declining tops line trend channel that it's been in since March, April, but it also was able to leap over that horizontal resistance area as well. Now you can see that there is a little resistance right now that it's getting ready to face at that June top. But looking at this PMO, it's very healthy. The OBV, the volume is going the right direction. So I would actually look for this to move higher. I think we've got a nice setup here. Next is Stitch Fix. I did not know that they had their own stock and IPO back in November. I actually adore Stitch Fix. They keep me from having to go out and shop. It's nice. I like it. So anyway, we can see that Stitch Fix managed to bust above overhead resistance here at these highs that we saw back in June and in December, and it is continuing higher. I have to say, we don't have the kind of history I would like to see, because it is off an IPO. So it took a little while before the PMO was able to be calculated. But it is very overbought, and, but it's hard to make a claim one way or the other basically because we just don't have the history. But I think this was a nice move. It was about the size of this consolidation zone, and it popped above that as far as a consolidation zone. So 26 to 30, and now you're looking at 30 to 34, and we're starting to move above that. So I think that was very positive. Of course, a 10% move in one day, probably not the day to get in if you were going to take a chance on Stitch Fix. Wynn Resorts, another really nice breakout. Notice the PMO is just now curving upward. Very nice setup. Declining tops line. We've got a break above that. We're, just a little more than half through this area of support and resistance. And we really need to get above that 200-day EMA, but I like the setup. It looks like we're going to get that move off of that breakout. And again, a lot of times when you get these really solid, strong breakouts, you'll generally see a little bit of a pullback towards the breakout area. So even though these have had like 3.5% moves to the upside, if you add it to a watch list, you're probably going to see it pull back somewhat. And, after a move above resistance or outside of a declining tops trend line. All right, let's look at some of these downgrades. Some of them look good. Some of them look bad. This is one of the bad ones. American Tower Corp, AMT. You can see that we had a breakdown below the support level at about 140. And I've got a PMO that's topping in what I would say near-term overbought territory, because it's near these tops right here back from February and March. So it's near-term overbought, and now it's turning back down. We've got this move below the 50-day EMA, below support at these tops from May and June. Don't like the looks of this one. You know, I guess if you wanted to try and short here, you could probably make a case for that, but I don't do that in a bull market. Just like Tom, I don't look for shorts. Biogen was on the downgrade list, and you can see it had that huge gap up when we really saw lots of biotechs doing very well on Friday. That was pretty much the day to see them move. We had a trial, I think, that was released at one of the other biotech companies. And, you know, it definitely got to enjoy that rally. But now we have this huge gap. We have pulled back down to what I consider a little bit of a support level, mainly because, of course, it's gap support from where we did have that big gap up. I just think we're really vulnerable to having to close that gap. And, you know, again, maybe if you wanted to go on the short side here, but you can see the PMO is still not really decelerating, even on this move back down to gap support. Let's look at Cerner Corp, another downgrade. And you can see we had just gotten this breakout into you know, just above that May top, and you know, it looked like it was going the right direction, but you can see now the PMO is tipped back down. Of course, you've gotten this major pullback here, but you know, it's really close to some support here at the February low and the top here in April. And you know, if the 50-day EMA holds up, I mean, this could be an opportunity. I like the way the OBV is set up, but you know, I've always talked about this. I don't want to force a trade. May look good, may have some opportunity. I can add it to a watch list, but you know, I'm going to be really picky when it finally comes time to pull the trigger. And so looking at some of these setups, while they are promising to some degree, I would be a little bit, you know, I would be waiting for the really good setups. All right. Chipotle Mexican Grill, another downgrade today, down almost 1.75%. You know, the PMO is looking okay. It is starting to decelerate to the downside here just a little bit. But ultimately, you know, price is still staying. You can look here in the thumbnail. It's still staying above this low we saw back earlier, you know, a couple weeks ago. The 20-day EMA obviously looking like it's going to hold up for support. Strong scooter, you know, like I said, OBV looks pretty good, but I don't see this as a great opportunity. You know, at best case, we're in this trading zone area, and, you know, we're vulnerable to more pullback if that 20-day EMA doesn't hold. Square, and we talked about this one a lot. I know this has been a darling in the technology area, so it was a little bit surprising to see a downgrade for Square. You can see the PMO is turning down below its signal line, and we even failed to get up to test that overhead resistance and have turned back down. Now, I think there's an opportunity here to watch that gap, because you'll notice you can't see the gap as clearly here on the chart, but in the thumbnail you can see that gap very clearly. And if we can hold that gap support, or even close the gap and then make that run back, I think there's some time here. It does need to pull back. You know, the PMO is turning down below the signal line, and that's really a red flag for me. So it might not be the time to get back into Square, but there's going to be some opportunity here, especially if we see a bounce off of that gap support level, and if the 20-day EMA holds. And finally, let's finish off with Terex and Urban Outfitters. This one I loved, double bottom, 50 just crossed above the 200, PMO buy signal. So even though this one's on the downgrade, I see a lot of potential here still. And even on the downgrade, it's holding this area of support. So watch this one closely. I would add this to a watch list, because if this double bottom executes, you know, you're looking at a move to come up and test these highs back here. So risk reward could be really interesting on Terex. Urban Outfitters, will finish it off for us. It's in a trading zone. I don't see anything exciting here. PMO is declining. Certainly better trade setups, but it is holding that consolidation zone. And maybe if it pulls back toward that support level, get in on trading zone. On the trading within the trading zone. If you get back down to the bottom, you can still take advantage of a move to the high side of a trading zone. That's the finish of our upgrades and downgrades. So Tom, let's have you take it away and give us our review.
Okay, let's take a look at a couple of charts to start off. First, I thought what I would do is start with the weekly charts on the major indices. So as we take a look at where we stand here, we're basically midpoint of 2018. We went through a lot of consolidation, went through a lot of volatility, but it seems like, especially with the volatility index now back down into the low double digits or lower double digits, that the market is ready to resume its move to the upside. We've already seen it on the NASDAQ and the Russell 2000. And it seems like the Dow and the S&P 500 are looking to follow suit. So let's start off here with the Dow Jones. This is going back just the last 3 years. I'm going to show you a longer chart on the S&P 500 in a moment, but let's focus here on just the 3-year chart. We had a huge move up in the fourth quarter of 2017 and into the early part of January 2018. And after that, you can see the PPO, the weekly PPO rose to almost 5. And what that means is that you've got a 5% difference between your 12-week EMA and your 26-week EMA. So that's showing a lot of short-term strength, where your short-term moving average is accelerating away from your longer-term moving average. And when this happens, you do need time to consolidate. And I remember writing about this back in late January, early February when we sold off. There was a lot of talk. Is this a correction within a bull market, or is this the beginning of a bear market? And I'll talk a little bit about relative ratios later, because I look at that to see what's going on under the surface of the market. But when I look at the price charts, and there is nothing more important to me than the price charts, the combination of price and volume. So we had the first move up. A bear market is not made with that first move to the downside. The bear market is generally forms and the picture starts to develop as it bounces. You start to see money rotate into certain areas or out of certain areas. And here with the Dow, we pulled all the way back down and set a pretty important low, at least on a short to intermediate term basis, down in the lower 23,000 range. And you can see after a bounce back up close to 26,000, in early April, we went down again and tested this close to 23,000 level. And now we're just kind of consolidating. And while all this consolidation is taking place, the volatility is beginning to dry up. And when the volatility dries up, then the shock factor that we had to suffer through for several months tends to subside. And so the market tends to react much better to bad news than it does when the volatility is high. And that's when we had those huge sell-offs back earlier in the year. But I see consolidation here right now on the Dow. The Dow's had to go through a lot. Obviously, all the selling that took place in January here in the U.S. Gripped the Dow just as it did in all the indices. But the Dow's also had to suffer through a rising dollar. The dollar bottomed back February, March timeframe. So the dollar's been moving higher, and that cuts into the earnings and earnings estimates of these multinational companies that reside in the Dow. So that's been a headwind. And then, of course, the trade wars. These are companies that do a lot of business internationally. So all the trade war talk has had an impact here as well. But I'm looking at the Dow, and I see eventually a breakout coming above about 25,400. And when we get that, I'd look for another 1,000-point rise to test that January high. From there, we'll reevaluate. We'll see what's going on, where the market's going, where the money is going, really more so than where the market's going. But is the money rotating into aggressive areas of the market, or is the money getting more defensive? We don't want to see money getting more defensive as we break to new all-time highs on the Dow and the S&P 500. So that'll be something certainly to watch for in the second half of the year. But I do think that the bottom is in. I think that earlier low, February, and then the double bottom that went in April, I think marked the bottom. And when we break above this 25,400 level, I think that's going to confirm it. The S&P 500. Now, I've got a longer chart here, longer term. This one goes back to the start of the bull market, or at least back in the middle of 2009. Connecting the lows, you can see that there's a really nice long-term trend line in play here. We remain, I didn't draw a channel line, but I could have. Actually, let me go ahead and do that. All you have to do is grab this right here, and I use the command left clicker, and it just, you can get the same angle. And notice how beautifully that fits in there with those tops. So I think that is the channel that we're in. And so where we're sitting right now, based on the channel, I think there's just as much upside as there is downside within this channel. And I think we've already marked very significant bottom on the S&P 500 down near 2,500. 2,800 is where we have struggled on these last couple reaction highs, these last couple of attempts. And I think a breakout above 2,800 would signal to me the opportunity for the S&P 500 to resume its bull market that it's been in for 9 years. The other thing that all this consolidation did is it allowed the PPO to fall back close to centerline support. I mean, again, here on the S&P 500, we got up close to, I don't know, 3.5%, 3.75% or 3.75 on the PPO. And if you look back, that's not throughout this bull market, that's not a high. We've actually hit 4 and gone above 4 in the past. But when you start getting up to those levels, the market gets very overbought. You can look at the weekly RSI. We got up to 90. I can't recall ever seeing a weekly RSI at 90. But when we went through all the consolidation, first look at the PPO working its way back toward the center line, and then look at the weekly RSI moving back into the 40s. And normally, the 40s tend to be really good entry points on a weekly basis. You get a weekly RSI 40 in a long-term uptrend. That normally is a good entry point. And so the end of March looked like that would be a good entry point. So far, it has certainly turned out to be just that. I think the S&P 500 goes higher. I would not be surprised. I wrote an article in Chart Watchers not that long ago saying that I think that the strength is really going to shock some people. I think the market's going a lot higher. And I think we could make a run for the top of the channel later in 2018, maybe into early 2019. Okay, let's keep rolling. Next up, the NASDAQ. So that was a longer term chart. I think on these others, I've shortened the chart again. I just want to give you a feel over that long-term chart. The NASDAQ ran into some momentum issues back in March when it broke to another new all-time high. The Dow didn't do it. The S&P didn't do it, but the NASDAQ broke to an all-time high in March. But the problem was, had a little bit of a negative divergence, and that's not my primary indicator. But when you go back down and you fail to hold the breakout with a negative divergence, a lot of times it'll lead to a 50-period test and to a center line test on the PPO. That's what these pink arrows mark. We never quite got down there. We did start to see strength on the NASDAQ when it was probably about 100 points above that 50-week moving average. But we have now turned back up to the upside, and I believe breaking out to new highs. I love the fact that we're pulling back, holding the rising 20-week moving average, and now trying to break back up again with a strengthening PPO. I think the momentum is on the side of the bulls, and I look for higher prices. The Russell 2000, very similar, actually maybe even a little bit better than the NASDAQ. We didn't get the breakout in March, but that's about the time the dollar bottomed. And then the dollar started rising. And with that rise in the dollar, the small caps began to outperform in a big way. The last 3 to 4 months, Russell 2000 has been on fire and technically breaking out to an all-time high, pulling back but holding on to that rising 20-week moving average. And you can see the 20-week currently is at 1620, and we've got good price support at 1600. I think we've got some real solid support here on the small caps. If we do have a summer pullback, later in the summer pullback, I don't believe we're going to have one. But if we do, I think 1600 is a possibility on the Russell 2000, but I would be a buyer of any pullback like that. All right, let's talk about some of the sectors. First, this is, again, weekly charts. Let's take a look at the XLK, technology. We want to know if we're moving higher, how are these aggressive areas performing? And you can see with the XLK back in March, like the NASDAQ, we broke out. negative divergence. We failed to hold the breakout, and we pulled back, hit price support around 62.5, 63. Didn't quite get all the way back to the 50-week moving average. I would have preferred that, but it does look like that price support held nicely, turned higher, broke out to a new high, pulled back, hitting the rising 20-week moving average and bouncing off of it. I like the way the XLK looks. Consumer discretionary, the XLY, big breakout here in June, taking out the January high. Again, this is, we're seeing a lot of the small caps, a number of the areas within consumer discretionary, many of the retailers performing extremely well. And as a result, we were able to get a breakout in consumer discretionary, even though the major indices, the Dow and the S&P, were unable and have been unable to do so. Notice we pulled back, hit that price support level around 108 on the XLY, and we're bouncing, looking to break out again. And we're doing so with that PPO back on the rise. Good action so far in the consumer discretionary. Industrials and financials, where it gets a little interesting with the the four aggressive sectors. Industrials have pulled back, been consolidating. Like the Dow Jones, the industrials are being hit by a number of factors. Number one, the selling that took place back early in the year. And, we saw all stocks here in the U.S. anyway, selling off really around the globe. But then also the move higher has been very labored on industrials because they're fighting headwinds from that rising dollar. Got a lot of industrials like Caterpillar that do business around the globe. And I think a number of these large cap industrials are really struggling because of that headwind from a rising dollar. And then you've also got the trade wars, the anticipated trade war, also holding back many of the industrials. But good news is technically, I think the two key areas of support have held. I think that we've got great support in the 69.50 to about 72 area on the XLI. I think the bottom is in on this group, and I'm looking for the strength that we are now seeing to continue to resume. Watch the 20-week moving average here on the XLI. If we can get above it and then start to trend above it, that would be a great sign on the XLI. Financials, the XLF weekly, very similar to the industrials. I will say that the struggling 10-year Treasury yield is adding even more weakness in the financials, but I think that we're closer to a bottom in the 10-year Treasury yield than we are to a top. And as a result, I'm looking for financials to move higher, led by banks, life insurance companies, asset managers, investment services, those types of groups that should do well in a rising interest rate environment. Keep in mind, interest rates are still very close to historic lows. Just because they're rising isn't necessarily a bad thing. They're still very low. The economy can handle, a blip higher in Treasury yields. I don't think there's going to be an issue up to 4.5% on the 10-year Treasury yield. And again, as I mentioned earlier, I'm really going to be watching closely for JP Morgan's quarterly earnings report to see what Jamie Dimon has to say about interest rates, whether JP Morgan is still looking at the higher interest rate environment in the second half of 2018 and in 2019. If they're still seeing that, that's going to give me a lot of reason to be confident about this group. And a breakout back up above, say, 27.50 to 28 on the XLF would be very bullish. We have bounced at 26.5. We're now back to 27.20. Can we continue this move back to the upside? Once we get above that 20-week moving average, like the XLI, will we be able to hold it? We're seeing great action on the XLK and the XLY in that regard. And so now we'd like to see the other two aggressive sectors do the same thing. That, to me, would be very solid confirmation that the market rally in the second half of the year and into 2019 is very sustainable. Energy. I brought this one up. It's not one of the aggressive groups. It kind of trades on its own. There's a lot of different factors that go into energy, a lot of geopolitical issues that we have no control over whatsoever. And so, energy can look really good one month and the next month look like you want no part of it. So it's not really a group that I look for in terms of determining sustainability in the advance on the S&P 500. Very much similar to materials. in that regard. Materials can be driven by the dollar. We can have a really strengthening economy. Things can look great in a lot of areas of the market, but we've been struggling with commodities in this bull market. Commodities have not participated the way many of the aggressive areas have participated, and that's because this bull market is accompanied by a rising dollar, whereas the last bull market was accompanied by a declining dollar. So commodities did great in that last bull market. This one, they're really struggling. I'll get to that in a second. But here you can see energy holding a trend line. This is probably what I would watch more intently than moving averages, because you can see that we just sometimes everything looks good and the moving averages do nothing for us. We just go right through it. So I do think you have to be careful with energy. I don't think it follows the same technicals that I tend to see in other areas of the market, but I would follow this trend line. I think that we've now gotten a few key points along it. We've also got really good price support down around 66 on the XLE. Currently, the trend line comes in at 66. So I think we could be in a wide range here. I'd just be careful. I think energy is volatile, but still looking bullish at this point. I did mark the test of the 20-day moving average here, or 20-week moving average on the XLE, which was bullish. We bounced off of it, continued pushing higher. I think that's good. If we fail to hold the rising 20-week moving average, we've seen before what can happen. So you want to be careful if that's lost. I think we could potentially drop all the way down to 66 if we start to see crude oil prices roll over for whatever reason. Okay, let's keep moving. Next up is non-farm payrolls. I don't know if you've seen this chart, but if you type in dollar employ, EMPLOY, you get a history of the non-farm payroll numbers. And if you notice, the bear market ended about the time the jobs decline ended, and the bull market started and has continued going as jobs continue to pick up. If you look back at prior bull markets, you'll see the same thing. I mean, we don't really have warning signs until all of a sudden the jobs start to tumble. And so when I look at this right now, I'm seeing no sign of weakness at all. Back in 2000, you can see, we were going straight up into the beginning part of 2000, and then we started to weaken a little, and then we rolled over, and of course, the rest is history. 2007, we saw a little bit of weakness in the middle of the year, and by the early part of 2008, it was starting to roll over, and of course, we know the history there. I'm not seeing any of that at this point. So I think this is another key factor to keep in mind. All right, let's talk about the dollar and interest rates here. This is a chart that if you've been watching Market Watchers Live, you've seen plenty of times before. But one of the drivers of the dollar is the treasury yields here in the U.S. versus treasury yields in foreign countries. I like to follow Germany. Pick whatever you like. But this is a chart of the U.S. Treasury, 10-year Treasury versus the German 10-year Treasury yield. And it is continuing to move higher. It's just broken out to new highs. And if you look at the kind of long-term view, don't look at all the individual gyrations, but you can see that the rates throughout this bull market, rates have been rising faster in the U.S. than in Germany. And that overall has resulted in a higher dollar. But we go through these periods where we have the negative divergence, where yields are rising rapidly in the U.S. relative to Germany, but the dollar goes the other direction. And so the positive correlation that we've grown accustomed to occasionally will show a negative correlation. And I pointed this out much earlier in 2018, but the last two times we came out of this negative correlation, you can see the correlation marked with these circles. The last two times we saw the dollar, it just explode to the upside. And with that, we saw small caps explode relative to the S&P 500. This is not saying that the Russell 2000 is going higher. This is saying that it's going higher much more rapidly than the S&P 500, or it's outperforming the S&P 500 wildly. Well, look what's happening now. Since we had that negative divergence again, we've seen now all of a sudden the dollar beginning to pick back up. It's now trading with that overall treasury yield move to the upside. And you can see that the dollar it's hesitating here at 95. But if we get a breakout there, I would be looking at a breakout on this relative strength on the Russell 2000. But since the dollar bottomed and started moving higher, look at what the Russell 2000 is doing. Same thing it did the last two times. When the dollar's on the rise, money rotates away from the Dow, away from the S&P, and small caps benefit. All right, let's keep moving here. So the question becomes, with the dollar, here is the trend line. I think it continues to rally later this year. If you disagree, then we're probably going to disagree on a lot of things, because most of my theme in the second half of the year and into 2019 is based on a rising dollar. So I don't like commodities. I do like small caps. Been talking about that for the last few months. I think it's going to continue. I think small caps will continue to lead. I'm looking for a breakout. I think eventually we're going to go back up and test this 103 level on the dollar index. And in that kind of an environment, small caps should do well. Unfortunately, the CRB commodity index does not do well. This is relative to the S&P 500, by the way. This is not an absolute decline. It's a relative decline. So it has been underperforming the S&P 500 since the moment the dollar bottomed. And so if you believe the dollar's going higher, I think you got to look outside of commodities. Energy's been performing pretty well, but again, we know how volatile that can be and how it can move quickly back and forth. So I would just be really careful with commodities and gold, that sort of thing, with a rising dollar environment. Now, what would change? Well, if we were to go back down and take out 88 to the downside on the dollar index, I'd completely change my opinion on the market. But until I see that, I would continue to avoid mostly the commodity space. Okay, let's keep moving. We got a couple of relative ratios I want to talk about. Those of you who follow my blog and follow me here on Market Watchers Live know I like to see what's going on, especially with consumer stocks, consumer discretionary versus consumer staples. The chart that I've got here is the XLY versus the XLP. So again, this is not giving me absolute performance of consumer discretionary. It's telling me how it's performing relative to consumer staples. Back in 2005, we topped on this ratio. You can see 2006, 2007, really struggling to break out the new highs, even though the S&P kept going up. And by the time we reached that final high on the S&P 500 in October of 2007, this ratio was falling like a rock. It had broken down to multi-year lows, and that's what I'm talking about. When you're breaking out on the S&P 500, you don't want to be led by defensive stocks. I want to see, when we're moving higher, I want to see this index or this ratio moving higher as well. And if you check out what's going on right now in the XLY, XLP, I see no problems whatsoever. The S&P 500 has been going higher. Yes, we've had some consolidation, but it is being led by a very, very strong consumer discretionary group relative to staples. And that, to me, tells me we have a sustainable bull market in play. The other one I use that I don't use as often, I don't feel as comfortable with it, as transports versus utilities. But you can see the transports versus utilities throughout the bull market. Yes, we've had some sudden drops and so forth, but for the most part, this ratio of transportation stocks versus utilities goes higher, and the S&P 500 goes higher with it. When we consolidated, and actually when we had this huge pullback in this ratio, the S&P 500 was struggling. And I remember back in early 2016 being a little bit cautious on the market because some of my relative ratios were starting to fall apart. And we were losing some key support levels. But what I was watching was price support on the S&P 500. We never lost it. Came back up, and look how quickly this recovered. And just recently broke to a new high. Probably not at a top in the market when we're just breaking to a new high on transports versus utilities. So those were a couple of charts I think that are really important as we go forward, and I wanted to mention those. And now I want to go through a few relative charts. And what we could do, and I'm going to go do this a little different. It's not pre-planned charts, but what I'll do is go into the sector summary. And let's take a look. Last 6 months, we've seen a lot of consolidation. So let's take a look at the last 6 months. And you can see that while we've been consolidating and the NASDAQ's been breaking out, Russell 2000's been doing well, top two groups, you would think with all the consolidation and selling, especially Dow and the S&P 500, that consumer discretionary and technology might be under pressure. Last 6 months, they're the leading two groups, and it's not close. Third place is not even close to second. So these are your two leaders in 2018 so far. So these are the two I really want to try to concentrate on. If the market continues going higher, I think we're going to get recovery from financials and industrials. I think there's certainly going to be some opportunities there, but I would not ignore consumer discretionary and technology. So when we go in here and look at the 6 months, check out what has been working. Specialty retailers, broadline retailers, apparel retailers, clothing and accessories, footwear. I think you can see the theme that has been working. I would continue to stick with that theme as long as it works. So those are all groups that I would be very interested in as we go forward. To the downside or some of the others, and I'm going to talk about this group a little later in the show, but media agencies, actually, I just wanted to pull up that chart. I think we're getting really close to a breakout in this group. We've talked about this on several occasions. We're at 589. You want to look at the PPO on a daily basis. This looks really good bouncing off the 20-day moving average. The only reservation I have with this group is the weekly chart. And so if we go back, and I'm going to pull up last 7 years, because I want you to see how fast this group can move up when it moves. 2013, when we had such a great market, we started the year around 375, 385, and by the end of the year, we were at 600. We're talking about a 70% move in this group in 2013 when we had a good year. The past 2 or 3 years, we have been slowly moving lower, but check out the double bottom here coming across right at about 520. I think that's important. And now it looks like on a weekly basis for the first time in over, close to 2 years, the DJUSAV media agencies is broken back above the zero line. And we have a couple of tops here at 590, sitting at 589 right now. If we could get that breakout, I think this is a group that could be looking at something similar to what we saw in 2013. So I'm going to be paying attention to some of the stocks within this space as we go forward. So those are some of the things to look for, I think, in terms of the consumer discretionary. Let's keep going back. Let's take a look real quick at technology, and then we'll wrap this up. Over the last 6 months, software. I'm already seeing Microsoft making another push, trying to break out. Even Red Hat, that came out with not so good numbers. Actually, the numbers weren't as bad as the reaction, but the stock got hit very hard to the downside. It's starting to come back. Software has been a very strong part of the market throughout the bull market, but especially in 2018, as you can see, rising 16% in a market that has really struggled. So I think software is a group we want to continue to look at. Computer hardware, no doubt we want to watch. That's home to Apple. I'll pull up the Apple chart in 1 second. Internet stocks continue to do well. I look for them to continue to perform well as well. Semiconductors still have some work to do, but normally that is a group that tends to lead during a bull market, so I would not be surprised to see continuing strength there. But let's, as a final chart, let's pull up Apple. Everybody likes to know what's going on with Apple. Recently, higher prices, lower PPO, not much volume on the breakout. We had a negative divergence. I saw multiple signs of slowing momentum. Wanted to see a test of the 50-day moving average and the PPO center line. We got both. You can see Apple came all the way back down to test the breakout level and the 50-day moving average, reset its PPO. I think Apple is starting a pre-earnings run to the upside. I would not be surprised to see us break above 194, 195 on Apple before earnings come out, and I'm looking for a big report out of Apple. Okay, that is about all I have for this mid-year update. Hope you enjoyed it. I do want to bring up a poll after we go through the summary quickly. But you can see we took a look at the major indices on a weekly basis, and that's kind of my big picture view when I'm looking at price volume. Daily charts help me trade. Weekly charts help give me perspective. And so I'm still very bullish based on these weekly charts. Looked at the weekly charts on several of the key sectors that I'm looking at. Looked at the dollar and commodities relative ratios, and then just a little bit at relative strength in a couple of key areas. So hopefully that was a good mid-year review. And let's take a look at that poll to see what everyone thinks is going to lead in the second half of the year. This technology looking to lead, according to everyone, 44%, financials 24%. The one that really surprises me there is consumer discretionary, down at 7%. An expanding economy where we've got 2/3 of GDP, consumer spending makes up or comprises roughly 2/3 of GDP. If growth is expanding, I would think that consumer discretionary is going to continue to lead. That would be my choice. but I do like technology, and I think financials are also a good choice. Industrial's been weak, but I look for them to bounce back as well. And I don't know, Erin, do you have any, what do you think about the second half of the year? What are you looking for leadership?
You know what? I went with the financial sector. It's been kind of depressed over the past couple of months. It just hasn't been performing the way I would want or expect. And I'm looking for financials to do very well in the second half and possibly be a leader. So that was really my place. And honestly, I was thinking about industrials only because, again, they've been out of favor for so long and they're now finally starting to pick up. It's just going to be a matter of, I think it's going to, I would be looking, I don't generally pay attention to all the news. I feel like everything's baked into the chart. But I think that, with the trade talks and that sort of thing, the big, like you're saying, the expanding economy and what, strong business environment. I think industrials could be a place, but, as a leader, I'm not so sure about the leader, but I suspect it's going to do well.
Yeah, the industrial is one thing, and I read this recently, and it kind of rings true a little bit. Industrials really have been kind of a poster child of that sell on the rumor, buy on the news.
Yes.
We always think about buy on the rumor, sell on the news, but it's like the opposite. All the trade fears that were, permeating headlines every single day. Once everything, became effective, or once, many of the goods between China and U.S. became effective, the tariffs, that's when industrials bottomed. So it was almost like everyone was selling on the rumor, waiting. And then as soon as the news hit, we see money beginning to flow back into that space. And I wonder if it's going to continue. I think it will.
Yeah. Excellent. Well, thank you, Tom. That was awesome. And it obviously was very good because we didn't get that many requests for 10 and 10. They were too busy watching you do that wonderful presentation.
Thank you.
I'm going to go grab the screen now. Let's take a peek at what we do have here. All righty. Here we go. 23 of them to look at. And the RRG was pretty interesting, actually. Let's make it short term. And make our tails a little smaller, fit it in there. Yeah, so I saw a lot of interesting ones here in that weakening category, starting to move back up toward the leading category. So I thought those were pretty interesting. And you could see a few of these others with a northeast direction. And then finally, as far as sectors go, technology, everybody was interested in that as far as the poll was concerned, and clearly favored as the requests go as far as the 10 and 10. So let's go ahead and get started. And I do want to mention, if you are in the chat room live, currently the winner, the most popular request is NVIDIA. But if you want to see AMD or Netflix, get in there and vote, because there is still a little more time. Just go ahead and like those particular requests in the chat room.
All right, let's get it going. I've got SAIC as the first one, and I went ahead and annotated this one. I think we got a couple of key areas to watch the upside. The good news is, even with all this selling that we saw back in the second week of June, we pulled back. I think there's a key area of support at about 79. We hit that, and so far we're bouncing above it. I love the fact that we were able to get back up above the 20-day moving average. Those are the good things. The tough things are, I think we still have some overhead resistance that we're going to have to negotiate in terms of this gap resistance, 87 to 88. And then, of course, we have the high back in May at 90 to negotiate. So I think right now, SAIC, I just look at it as being in a trading range. That's the way I would trade it. If it breaks below 79, I don't like it. And if it breaks above 91, I think we're going to be looking at some higher prices ahead.
All right. Well, the most popular, NVIDIA, pulled it off by 4 votes. So good thing, because we wouldn't have looked at it normally, because we have peeked at it in the last week. And I try not to replay any of those. So NVIDIA.
Yeah, I think NVIDIA's done a couple of really good things here. I did mention when it broke out in June, you got to be careful with NVIDIA, because it does historically perform very poorly in June and July. I think from what I recall, the average monthly returns were minus 4.7% for both months, going back the last 20 years. And you can see that certainly played out in June. NVIDIA had a very rough June, but so far in July, trying to get back some of these losses. And it has cleared both the top and bottom of gap resistance that we saw in some pretty heavy volume back on the 25th of June. So I think it's good news. We've held the recent lows, which I think is important. And so at this point, I think what I would be looking for is a trip back up on NVIDIA to retest that high around 267.
Okay. You know what? It came in second, and we haven't looked at it within the last week. So how about AMD?
Okay, AMD, I tell you, the war back and forth between AMD and Intel has been interesting. It seems like one goes, catches fire, the other one pulls back, then the other one catches fire while that one pulls back. It's been kind of a whipsaw back and forth between AMD and Intel. But currently, I like the chart on AMD. I mean, if we take a look at this, I see a cup after an uptrend. So actually, let me put the cup in there first. But there you can see the high, the low, and now what appears to be, you can kind of see this cup forming. I think we may hesitate a little bit just above $17. If we do break out, make sure it's got volume, because otherwise you're going to have a negative divergence that I'd be careful of. But if we get the heavy volume breakout, that would be bullish. Otherwise, what I would expect is maybe to reverse at 17.10, maybe pull back one more time, hit that rising 20-day moving average. But this pattern overall, to me, anytime you've got a stock that has made this kind of a move to the upside, I mean, that is a clear uptrend. So what you're looking for are continuation patterns. That's what a cup provides you. So if we get this cup to complete up just above 17, and then maybe get a pullback to that rising 20-day moving average, I think that's best entry on AMD. I like it. I think it goes higher.
All right. Let's see. Let's go with, as our next one, BERY. And that is, where did I find that? That's, yes, plastics, materials. Yes, the materials industry.
Yeah, I talked earlier about material stocks just not performing very well. I mean, in the short term, we can get bounces from time to time, but this is not where the money is going right now. So I'd be a little careful. Up maybe 50-50 is going to be, that was after the gap down. You can see the reaction high. A couple of different days got up to about 50-50. And so that's about where I stand on this stock. I'd say I'm about 50-50 on whether or not this thing goes I would watch the current trading range. Keep in mind that this trading range is off of a downtrend. So the more likely scenario is to break down. But I do think we're in a bull market, not a bear market. So I'm not sure I would be looking for that breakdown. But until it breaks out at 50-50, I would just be looking for more and more consolidation. I do like the fact that we had lower prices with the higher PPO. So I think that's what's helping us get back toward that 50-day moving average. And the last high was at about 48. And that's right where the 50 is right now at 48. So I think we got a little bit more room here. I'm going to say another 1.5% higher on Berry Plastics up to 48. And then we'll see. But longer term or more intermediate term, I think the trading range is 45.50 to 50.50.
All right. Let's see. Let's go ahead and look at Nike. We haven't looked at that one in a while.
Nike has the highest scooter rank of all the Dow stocks. This is the best performer, in my opinion, on the Dow. So let's pull it up. And you can see the huge gap up. I love the fact it came down to 76. I think there are two key areas to watch on Nike in the short term. The first of which was hit at $76. That was our prior high. We gapped up above it. Volume over 30 million shares with its latest quarterly report. I thought that was awesome. The pullback to 76 was an opportunity. And then the other level that I would watch really closely is at the rising 20-day moving average. And that currently is just above 75 bucks. So 75.76, I think, is great support here. Short-term resistance, and I believe it's just short-term. I think we'll break out. But short-term resistance is just below that 80 level.
Okay. From the industrial sector, and for our friends in Canada, WCN.TO, Waste Connections.
All right, WCN.TO. Yeah, I mean, I like what's going on here. I think it's just consolidating off of an uptrend. That gets very frustrating, especially if you're a short-term trader and you're hoping it breaks out. But I think longer term or more intermediate term, I'm not really seeing anything that's bad here. I'd be okay with the stock all the way down to 97, to be honest. And we see the volume pick up in May here as we broke out above 97, pulled back, hit the rising 20-day. We held, moved back higher, and now we had a negative divergence. Higher prices, lower MACD, or excuse me, lower PPO. I haven't made that mistake in a while. Lower PPO, And then we failed to hold that breakout level and pulled back to this 98.5, 99 area, almost testing the 50-day moving average. I still would say 97.25 up to about 98.5 is the support level I'd watch. And what you want to see is a breakout, clear breakout over about 101.5.
All right. The next one is Ferrari Race, RACE.
Love the ticker.
I know, isn't that awesome?
Yeah, there are just a handful of ticker symbols that I love. I would buy it just based on the ticker symbol. That's the way I used to, when I went to the horse races with my grandfather when I was young, I used to just pick based on the number or the color or whatever.
Yes.
Yeah, so that carried
Doesn't work so well nowadays, but
yeah, it doesn't really work too well in the stock market, although sometimes it works better than technicals.
it seems that way.
Just occasionally. Yeah, I'm looking at it. I mean, I like the uptrend in play here. I love this volume coming in on the breakout. We pulled back, hit that 125, 126 area, broke to a new high. I think we continue to put in higher highs and higher lows, which is great. I like today's action, getting back up above that 20-day moving average. I think this gap down off of this downtrend is a fairly significant support level. So I think as long as we hold about 131.5, 132 on Ferrari, I think it looks pretty good. I'd expect another pushback toward 150.
Okay. The next one is healthcare sector, Steris Corp, STE.
All right, STE. Breaking out, that's nice. We had a negative divergence, higher prices, lower PPO. Didn't quite get to the 50-day moving average, didn't quite get to the center line. That's what I look for. But it looks like that's as far as it was going to go to the downside. It is now broken out. PPO turning back up again. I like it. I'm going to just take a quick look at I want to go back just a little bit further here and then annotate. Yeah, the uptrend's been in play here for quite some time. I would maybe be looking at 102, 103 as your key area of support to the downside. You could look at 108, 107.50 also, but that level right there on this pullback, you can see 102.5 held. This pullback, 102.5 held, and then we break out to a new high. So I think this is a pretty important support level. The other one to maybe keep an eye on is just the recent breakout just above or just below 108 when we broke out there. I would look for maybe a quick test of that level at some point in the near term with another push to the upside off of that.
Okay. Let's see. Investment services, interactive brokers, IBKR.
Yeah, with the sudden shift all of a sudden in the financials, this is one maybe to keep an eye on. It did go back and test, well, you got all kinds of different support levels, but there was a lot of volatility back in February, of course, with the overall market selling off. That was a big level. This stock continued to go higher and has been under pressure for a while now, but it's all the way back down to that February low. So I think anybody who's really, wants to take a little bit of risk here, I'm going to say between 58.5 and 60.5, I think is really good support. And if the financials do begin to move higher and the treasury yields begin to rise, this is one that I think could be very interesting over the next couple of months to maybe even into the end of the year. And a break back up above that 20-day moving average is really what you want to see. So I would just maybe highlight that as well so you don't forget. But that area right there above that 20-day I think is really important. You can see that failed back in the second week of June. We've been trading much lower. Volume's been heavy on the selling too, but it is starting to pick back up a little bit here on the bounce. Let's see if we can get through that 20-day moving average.
All right. And let's see, to finish it all off, let's go with, we haven't looked at it in a while, Boeing, BA.
All right, BA. I was looking at this one earlier, and it just didn't stand out to me. It's got some gap resistance. Look at the heavy volume here as we were moving down. We have gotten back through the 20, but we're consolidating. So it's not unusual to see a lot of this back and forth above and below the moving averages. So I'm not going to pay a whole lot of attention to that. What I am going to pay attention to, though, is a really strong long-term chart on Boeing. There's your consolidation in 2018 between 310 and 370, but this comes off the heels of a very, very strong uptrend. So I don't know how long the consolidation goes on, but I would be a buyer in the lower end of this range, and I would be a seller in the upper end of the range until we get that breakout. Once we break up above 370, especially if we get some volume coming in, I would look for another sizable advance on Boeing. I think eventually we'll break out here.
Okay. And that completes the 10 and 10 to 1. Here are the symbols that we did look at. I will have those up in the Market Watchers Live chart list, so you can go ahead and look for those after the show. And we'll be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
And here you go with our final market update. We can see that most of the major markets are up. Interestingly, though, you can see that the mid caps and the small caps not doing quite as well, with the Russell 2000 actually starting to hit some support from the Friday high right back here that we can see midday. We'll need to see that stop. I would like to not see this bifurcation on the market right now. You can see NASDAQ is, while up, it's been trading mostly sideways just above yesterday's close. The Toronto Stock Exchange, we're seeing a nice gap up on the open, consolidating sideways right near the intraday high. Treasury yields are up, currently reading 2.87%. TLT, after a big gap down yesterday on the open, we're just seeing consolidation moving sideways. Currently, TLT is down 10 cents at 121.86. UUP, the dollar, we saw a big gap up, but it has been pulling back from there, taking about half of those gains back. Gold, of course, usually traveling opposite. We saw a big gap down and what looked like a resurgence there in midday, but we're pulling back down again on gold. USO mostly unchanged right now, reading 1503, and currently the VIX is unchanged, reading at 1269. Wanted to give you a quick look at my climactic indicators chart, and here is the VIX on an inverted scale with the Bollinger Bands. I like to look at that. If you get a penetration to the upside, I think of that as a lot of bullish feelings out there, and it's sentiment. And sentiment is contrarian. In the very short term, I think the VIX is a great read for that. I've been noticing that breadth has been climactic over the past 3 trading days. And when I look at that setup and the VIX being that close to the upper Bollinger Band, and when you look here at the candle chart here for the S&P 500, we're now hitting some overhead resistance. And it does appear that it's time for a bit of a pullback. We might be looking at a buying exhaustion shaping up here in the very short term. And I say that because when you look at the short-term indicators, the Swenlin trading oscillators, you can see we're in very overbought territory for the short term. I would expect to see these overbought conditions clear. Good news is that we are still in a rising trend in a bull market. So a lot of times you can see these indicators unwind without a big decline. You'll see it maybe just grinding out some consolidation sideways to clear these overbought conditions. But I think in the near term, something to pay attention to. May want to wait a day or two to get back involved. Maybe we're going to see a bit of a pullback off of a buying exhaustion right now based on my ultra short-term and short-term indicators. And that really completes our final market update. I think it is time to move in to our final segment called Bottom Feeders. Tom, do you want to introduce the segment?
Sure. We've been talking a lot about chart breakouts and momentum sleepers and, those types of things that we've discussed on many occasions on the show. And I know there's a number of you out there that like to look at stocks that maybe haven't been performing so well, that might have opportunities to move back to the upside. And so we're going to look at stocks that, for the most part, they may not be setting 52-week lows, but they've been stocks that have been lagging for one reason or another. And, maybe they give us a little bit of hope here. So I guess with that, Erin, what do you see? I mean, what stocks do you think might present some opportunities?
All right. Well, the first thing is how did I find them? That's usually one thing that I like to go through. That's when I use scans, either the predefined scans or ones that I've come up with myself. And basically, I turned in and formed a bottom feeder scan. And I just wanted to explain what I was looking for. It's very typical to my regular PMO scan, so I'm not going to go over a lot of the front end here on what I look for as far as the PMO. But the one thing that I did change for a bottom feeder scan is that I wanted the 50 to actually be below the 200-day EMA and the 20 to be below the 50-day EMA. However, I want a 5 positive crossover of the 5 and 20-day EMAs. That shows you there's some movement going on. Plus, we're seeing the PMO starting to go. And then I had, normally I'll set it with a scooter between 20 and 75, but I had so many stocks come back. I went ahead and commented out that line and just came in with a scooter that is greater than 20. So I set it up not the way I normally would set up for an investment, because I do want to give myself the best chance. And to me, having a 50-day EMA above the 200 is optimal. But we were looking at bottom feeders, things you can feed off of that, have been trading at lows for a while and are now just starting to break out. So I went ahead and did that. And you can see, I always find it interesting to see what sectors come up when I finish with these scans and sifting. And notice a lot of them were financial. And what did I say, Tom, is what I think is going to be doing well going into the next 6 months is financials. I think the financials group will do quite well. So let's look really quickly. I have 6 of them, and I'm going to leave you some time, obviously, Tom, to get to yours. So this one is, the EMAs aren't that helpful because they've been braiding now because we're looking at a stock that's been in a trading zone. So why would I be looking at this? One of the reasons is that we are starting to see that PMO turning up. We might get that PMO buy signal. And although the 5-day EMA hasn't quite gotten above that 20-day EMA, what I'm liking here is the location within this trading channel. I see this as a pretty good risk reward setup, because you can set that stop near the bottom of that trading range, but you have that potential to try and move up to the top of that trading range. And with a PMO that's getting ready to have a buy signal in oversold territory, I thought that looked pretty interesting. Now, again, I don't typically go this direction for my investments, so I will caveat it with that. I think these are interesting bottom feeding opportunities, but I personally am not going to be going out and purchasing any of these at this point. All right, Citigroup. This one I found interesting in that we do have the PMO buy signal, and look at the improvement with volume here, and even the scooter on the rise. Now, it hasn't quite busted above this area of overhead resistance in the near term. And you can see it also lines up with this support level and previous overhead resistance level over here. So I would be paying attention to this one because, like I said, I think financials are going to start to improve. And if we can get that breakout here, that might be a great opportunity. We don't quite have that breakout, but we do have the 5 crossing above the 20-day EMA. Cardtronics was one of the other ones. And this one I liked. It's got a nice double bottom setup. And this is a technically, let me try and figure how to explain this, as textbook style double bottom. Textbooks tell you that these are reversal patterns. So you want them to be going down into them. So a lot of times you'll see a double bottom, but it's coming off an up move. I still look at them. I still think they're interesting, but this is textbook style. And we have a double bottom here and a test of that neckline. And look at how important that area is as far as overhead resistance. And we finally got the PMO buy signal, and it's sitting in near-term oversold territory. You can see that the the OBV is rising, scooters starting to move into that hot zone. I think this one, honestly, like I said, I don't tend to trade a bottom feeding opportunity here because I don't like those 20, 50, 200 setups, but I do like the setup here. I think it's really interesting. I think you could, keep an eye on it. If you want to get in early, just, set a tight stop, maybe at that 200-day EMA. But that one was really interesting, and it has been really moving sideways for quite a while. Chubb Limited. This one had a breakout above that declining tops trend line, and we do have the PMO buy signal. Look at the OBV and scooter, all going in the right direction. So we've been in this declining trend, and we're finally popping out above it. And there's still some room to run before we hit the first level of important overhead resistance. So again, I think you've got this risk reward opportunity where you could set your stop down here at that 50-day EMA, but look at your upside potential. It's still quite good. So again, the only thing I warn about, and I'm going to go over it over and over, is the 50 days well below that 200-day EMA. This is in a bear market configuration, meaning you shouldn't expect your bullish expectations to follow through. But I like this setup. The PMO buy signal sitting and oversold. I think that looks pretty good. Maximus was another one. And you can see we got the breakout above this resistance area. It has pulled back to that area of the breakout, and that's always something I like to see. We always talk about that, Tom. You get the breakout, and we're like, well, if we get the pullback, and we're getting the pullback here. And I don't see, as far as upside targets go, you've got this gap resistance area. I think that's certainly a good target to look for. The only concern I would say right off the bat looking at this is it didn't manage to get above that 200-day EMA. But you know what? It was celebrating its breakout to the upside. And now, like I said, it's pulling back toward that breakout point. But I think this one has a nice setup as a bottom feeding opportunity. New York Community Bank Corp, again, another financial, got that breakout, pulling back toward that breakout point. And now, you've got this look of, this trading zone. And again, you're very close to the bottom of that trading zone. You're really setting yourself up nicely for a move to the top of the zone. And you can see the PMO has just had a buy signal. You've got the OBV going the right direction. I'd like to see a stronger scooter, but this would be more of a short-term trade to me. So I wouldn't put as much emphasis on the fact that I don't have a scooter that is, sitting above 70, which is where I like to see them. Whirlpool, I thought was very interesting as well. Double bottom setting up here off of this decline into it. I was looking at not only the neckline here for that double bottom, but you can see that the resistance from the gap is right there at that neckline. If we get that breakout, you've got an upside potential here up to that 170 area, which, wow, lo and behold, matches right to some overhead resistance that we're seeing in the shorter term. So I thought this one looked pretty good. You've got that PMO buy signal coming in oversold territory, improvement on OBV, improvement on scooter. So those were my bottom feeding opportunities, stocks that have been kind of downplayed, moving sideways, but still have some interesting opportunity associated with them.
Okay. Well, I did things just a little differently, but again, trying to find stocks maybe that look pretty good from a technical perspective going forward. Maybe something price support, something that maybe would resonate with possibility of a reversal, or maybe just the group, the industry group that it's in, because there are some industry groups I've talked about that I really like. But what I did is I set up a scan. And in the scan, I have the daily simple moving average over the last 50 days being 500,000 shares. So I want to try to find stocks that have quite a bit of volume. I use the consumer discretionary sector. So I only looked at that group because that's one of my favorites. I just figured that would be, I'd be able to narrow it down. And then I looked at small cap scooters that are less than 40. So these are going to be stocks that do not have, are going to be kind of in the lower half, but they are small caps that could benefit from a rising dollar. And they're also within the consumer discretionary space that's been so strong. So from there, I hit the scan, run scan, and these were the results that I got. And there'd be a lot of different ways, I guess, that we could set this up in terms of scooters. We could rank them in terms of scooters from 2 up to 40, or from, in this case, 38 down to 2. But what I went ahead and did was I looked at some of these stocks, and I'm going to go through them and just bring the charts up and show you in the relative strength style that I use some of these stocks and why they could be some bottom feeders to consider. So the first one I have is MDCA. And MDCA on a relative chart, first of all, note the group that it's in, the media agencies. I have a few of these. I've talked to you earlier about 590 being a really big level for the media agencies, not only on the daily chart, but also on that weekly chart, breaking out to the upside. I think this is a group that could lead in the second half of 2018 and into 2019. So I'm looking for some stocks maybe that might fit the bill. Here, you might say, well, a huge volume down move, but to me, that looks like an exhaustive gap. That kind of volume, when you look back, I mean, that volume just jumps right off the chart at you, and it was a hollow candle, meaning that while there was a lot of selling going on, we did manage to come back up and finish above where we opened. Sideways consolidated here for a little while, and now all of a sudden, we're seeing the volume pick up a little bit as we make this break above the 50-day moving average, and you can see the 20-day now just crossing or getting ready to cross over the 50. So we got a golden cross. Haven't seen that in a long time. So I think this is a stock that could make a run, and I think 650 up to 675 would be the short-term target that I'd be looking for. 572 is where it is currently. I'd like to get it on a little bit of a pullback. Obviously, that would increase your reward to risk, but I would not be surprised to see the stock 650, 675, especially if the media agencies group is able to take out the 590 resistance level. Next up is EVC. I think this is in the broadcasting and entertainment space. And this one looks interesting to me because off of a downtrend, I see a reversing head and shoulder. So you got a left shoulder, neckline just above 5. Here is your reversing head. Here's the right side of the neckline. Here's the reverse right shoulder. And now a breakout above about 510 would measure probably up another $1.20 or so up into the 630 area. And if you notice, we broke down at about 620 to the downside. So I think that on a breakout above 510, we got a pretty nice run here. Broadcasting stocks, by the way, June was a little rough for some areas of the market, but not for broadcasting. Saw a huge move up in the group. It just broke out to another high recently. And so I think, a bottoming pattern, especially if it confirms EVC, it could be in a sweet spot here for a potential move to the upside. ETM. Here is another one that is in the broadcasting space. So again, we've got a strong group. This one does have a reverse head and shoulder, and it looks to me like it's trying to make the breakout today on some pretty good volume. 1.4 million shares. Looks like it's the highest volume we've seen so far in July. And we're just a little bit past the halfway point of the day. So it looks to me like the volume is there. A breakout above this 8 level could potentially measure up about another $1.70 to about 970. And that is where we opened on this huge volume candle right here. So I think ETM looks like another one that could make a run. BITA, this is Bit Auto Holdings. Media agencies, I thought when I looked on Yahoo that it was a technology company. But anyway, it's showing media agencies, 590. Again, if we break at that, can break out above that level. I do like the fact that we had this move to the upside and then fell back one more time, consolidating. Look at today with volume picking up. We tried to get a breakout, pulled back. I would just be careful of 22, 2250 in this area. I wouldn't want to lose that level of support. But if that continues to hold, I think the recent strength in volume here on the advance in May into the second week of June, I think we could see resumption and another move back up toward the upper 20s. Stock's currently at 23.47. I think this another one has an opportunity. SGMS, this is in the gambling space. The group broke down recently. Gambling stocks broke down, so not great there. But I did notice on a relative basis, they hit relative support against the S&P 500. So if we begin to see outperformance in the group, this is one of the better stocks in the space. Just a month ago, Scientific Games was breaking out on a relative basis versus its peers. And yes, it's pulled back, but the whole group has been hit hard. What I would look for is a move back above that 20-day moving average. You can see while we were trending higher, the 20-day holds. While we're trending lower, the 20-day tends to fail. So let's see if we can get back through. That's one to keep an eye on as well. SPWH, this is in the specialty retailers group. Sportsman's Warehouse Holdings. Specialty retailers have been on fire. So we got a great group. It's just a matter of whether or not the stock can perform well. On the last pullback from $5.80 down below $5, I think the volume was just kind of so-so, and we're into this gap support zone between, say, 475 and 5.25. So I think this is a pretty key area. And I think if we can break back up above 5.25, we'll be clearing that 20-day moving average. So this is another one I think that looks really good. And the last one I have, I've mentioned this one before. It is also in the media agencies area, Outfront Media. And I think what we had looked at before is we were waiting to see if the stock would make that breakout above 20. Over the last few days, it has. Look at the volume that came in to support this move to the upside. I think a pullback anywhere close to 20, 20.25 would really be interesting on Outfront. So those are the stocks I had. Erin had several. Let's recap those, and then we'll wrap up the show. So, yeah, I mean, I think that you do have to kind of have a theme, Erin. You know, when you're, like you said, you kind of look at the financials as being an area that you really like going forward. And, when you pulled up your scan, a number of financials showed up. Mm-hmm. I talked about a couple areas that I liked. And when I ran my scan looking for certain things, voila, there were a couple of interesting stocks in that space. So I do think it helps to have a theme.
Yes. And, it was, I did modify my regular scan by a lot. Usually I don't look for stocks that have those, negative EMA setups. But in terms of finding a bottom feeder, you need to see that over time in the intermediate and longer terms, it's been in a decline. It's on the bottom. But that 520-day EMA positive crossover, that tells you, boom, something's happening right now. And I think you could do that with volume scans. I know you've done that before as well, where you're, I think you had that as part of your scan today. Mm-hmm. So, yeah, I agree. And a sector rotation is something I didn't used to get that involved in. But, since doing this show, I'm sure you've learned a lot. I've learned a lot just by the different trading styles we have. And, now I'm seeing the importance of knowing which sectors are doing well, when you are in the business cycle, when, what's going on in the market in general. And yeah, I think that's all great. And, somebody had asked if we have the scripts available for those scans that we did. If you can send me yours, Tom, I'll put it in the Market Watchers live recap. I'll put my modified scan also in today's Market Watchers live recap. So just go to the Market Watchers live blog and you'll find them there.
Sounds good. I do want to mention before we leave that the Russell 2000 earlier today did hit an all-time high, 1708.56, which took out the earlier highs we saw in June. But we are getting reversing candle. So this is an interesting day for the Russell 2000. Could see a pullback, a cup forming with a pullback to the rising 20-day as a handle. Something to watch for.
All right.
Okay, sounds good. I do want to thank everybody for stopping by. We always appreciate having you here with us on Market Watchers Live. Please remember to complete the survey as you exit. I'd love to hear what you thought of my mid-year review. Feel free to disagree and send me your thoughts. We always love to get your feedback anyway about Market Watchers Live. Market Watchers Live does air 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we'll see you back here on Wednesday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.